We're now again on page 3D-1. What we're going to talk about now is this blueprint, what we call identify the characteristics of a freestanding and or embedded derivative financial instrument to be recognized in the financial statements. Well, like anything else, this area of embedded derivatives are what we call hybrid instruments. Let me tell you, my background prior to teaching full-time at Florida Atlantic was that I used to work for the Treasury, and my background was in determining the valuation and tax treatment of hybrid instruments. And that's a whole other arena if you ever want to specialize in that area. How the taxation of these things. But for our purposes for the CPA exam, it's just important to know the concept of what do we mean by embedded, what do we mean by freestanding. But these things can get really complicated. And I tell you, in this day and age, the areas when we're talking about derivative accounting and international accounting and fair value, this is what's taking up a lot of time because there's so many new financial instruments that are being developed. As we are speaking, FASB can't keep up with all the new type of instruments and how one should be treating it. So keep that in mind as you're moving into the profession. But with that being said, what do we mean by embedded derivatives? As the name implies, as the book says, it resides in a host contract and are not freestanding. Well, that's pretty obvious, not freestanding if it's embedded. But when you think about the term embedded, what does it really mean to you? When something is embedded, it means that it's not separate. It's not separate. It's built into that instrument. You can't sell it separately. That's the key thing. I'm going to give you the textbook definitions that the CPA exam is going to give you. But in reality, think about it this way. I can't sell that thing because it's part of an instrument. It's part of a bond. I can't just rip it out of the bond and say I'm going to sell it. It's embedded. So that's how you should think about it before we even get into the definitions. That's what makes it different than freestanding. Freestanding means, in the old days, you could pull up a coupon and just simply sell it on its own. So let's take a look at this. Again, an embedded derivative must not have the same characteristics of the host contract. In other words, if you got a convertible debt, that meant it's a debt instrument with maybe a conversion feature where you can convert it into stock. Well, in your finance class, you'll learn that there is no relationship in terms of pricing between a bond and stock. Matter of fact, they may be going in the opposite direction, the values of stock and bonds. So with that being said, it has to be not related to that bond's value, going in the same direction. So let's take a look at it. An example is a convertible debt, where the convertible debt is the host contract and the stock conversion feature is an embedded derivative. The underlying stock conversion is more akin to the stock price than it is to the bond. It has nothing to do with the bond. If that's one of the key criteria that you need to recognize when you're looking at something called an embedded derivative, because it's not freestanding, you can't sell it, but it's more akin to another instrument than it is to the host. So by definition, the opposite or the antonym is the freestanding derivatives, which are not embedded in the host contract, and you can sell it on its own. You can sell it on its own right. So what happens when you have this situation, when you have this embedded derivative or freestanding? What do? Well, there's something called bifurcation. Bifurcation is an issue that's always going to be tested on the CPA. So it's very important that you recognize what bifurcation is. Is when an embedded derivative is separated from the host contract for financial reporting purposes only. It is separated because each one has a value. Even though you can't sell it separately, it does have a component value. Now, the following must be satisfied before bifurcation is permitted. Now, this you need to know for the CPA exam. 1, the embedded derivative is a derivative by itself. I mean, you may say, well, it's embedded, but it may not be a derivative. A conversion feature would be. Now, number two, they always like to ask. Economic risk and characteristics of the embedded derivative are not closely related to that of the host contract. If it's a conversion feature to stock, Well, it's more closely related to the stock than it is to the bond. So it meets that criteria. And fair value is not typically used to record the hybrid instrument. That makes perfect sense because technically you're dealing with bonds here. And if you're dealing with bonds, bonds are usually not at fair value unless you choose that fair value option. So in general, if this embedded derivative is inside an instrument that is not used at fair value, then it will meet the criteria. And by the way, as the book talks about, if you already have selected a fair value option, who cares then? Because everything's going to be at fair value anyways. So it's irrelevant then. But they're really talking about an instrument that is not marked to fair value. That's what they're talking about. Now let's go on to page 3D-2. Now, if a hybrid instrument qualifies for bifurcation, the holder of the hybrid instrument may elect not to bifurcate. And once you do that, you have to live with it. You live with your decision. Now, if you are bifurcating, they are going to be treated no differently than any other derivative. They will be treated no different than any other derivative. Okay, let's go to the blueprint on 3D-2. Identify the criteria necessary to qualify for hedge accounting. Wow, if you ever want to talk about an area that is undergoing changes, this is it. And the one thing, like I always like to tell folks, that, as I mentioned earlier, counting changes so quickly, by the time I get my new textbook, they're already outdated. Luckily, I have a loose leaf service that keeps me posted every day. And it's that bad that I actually get text alerts about new changes and rules. And my wife laughs at me when I have these text announcements from FASB. But hey, you got to live and breathe this thing, because believe me, you'll be a dinosaur very quickly. You're going to be a dinosaur very quickly if you don't keep up with this. So there's two parts that constitute a hedge. You have the hedged item itself. What are you hedging? Is it some kind of bond? You know, what are you hedging? You know, and you have the hedge instrument. What is that? You know, so you got all these things. You got the hedge instrument. What kind of derivative is it? And you get the hedged item. Is it the bond? Is it the stock? What are you hedging? So those are the two major components that you have to have. Now, what do you hedge for? You want to protect yourself against volatility, interest rate volatility, currency volatility. Volatility is a bad word in risk management if you are from the financial management side. Now, if you're a trader, you live and die with volatility. But in the accounting world, where you are one that is trying to protect your company from adverse movements, you need hedging. And hedging is paramount. And that's why the area of risk management is a growing field within the area of accounting as well. So, reading the textbook on 3D-2, it says, the firm uses a derivative to offset exposure to volatility in the fair value of a recognized asset or liability or a purchase order, or what we call unrecognized firm commitment. Okay. A hedging instrument is a designated financial instrument whose fair value or related cash flow should offset the changes in fair value or cash flow of a designated hedge item. Wow, another lengthy definition. Hey, what they're basically saying in plain English is that if something goes up, you want something to go down. You want to protect yourself. You want a zero change. If something is worth $20 and it goes down by 10, you want another instrument that will go up by 10. You want it to be perfectly hedged. I don't want to lose any money. That's what they mean by that. You want it to be perfectly protected. Because the last thing you want to do is, I have a great contract I just made. I just have a great contract. I'm going to be selling this item out there to a European company, and I sold it for $1.8 million. I made a great profit. And then all of a sudden you realize 2 months later, when you're going to actually receive the cash, you're not receiving that money. You're receiving $300,000 less because you didn't protect yourself against the currency movement. That's one thing you don't want to see happening. That's malpractice. So as a CPA, it's your responsibility to get out there It's your responsibility to get out there and make sure your risk management is functioning well. And part of your risk management function is that your positions are perfectly hedged. Now, in life, as we all know, nothing's always perfect. So you may have something that may not be perfectly hedged. It may be off by a few percentage. Well, there's a rule that is being talked about and now has been implemented in the very near future. And we're going to be talking about that when we're going to be talking about effective hedges. We're going to be talking about that. And what do we mean by effectiveness? That's very important. That is extremely important.